I thought, what better way to start this than kind of formally convene the self-loathing venture capital society?
Well said. Yeah. Love it.
Yeah.
The two most curmudgeon-y people in our industry, about the industry at least.
It kind of feels that way, doesn't it?
Yeah. Well, I always remember you coming to my office, Bryce, and saying, Eric, you and I agree on all the problems in the industry. The only difference between us, Eric, is you're not willing to do anything about it. Which I laughed and I said, no, Bryce, the difference between us is like your solution doesn't work for it, and I think I can change within the system. And I actually was thinking about, like, it's a little like good entrepreneurship in my mind, right? Which is you identify a problem that you really deeply, deeply believe, and then you iterate like crazy on what are various solutions. And good entrepreneurs come up with lots of different solutions, right? And you and I don't know if we're good entrepreneurs. I think you're a good entrepreneur, but we've come up with radically different approaches to what we both identify as a pretty similar, or have a similar view on what the problem is.
And when you distill it down, what do you think the problem is?
My highest level comment on it is capital has no insights. That the venture capital industry thinks capital is this magic thing. You need capital, right, in order to build a business, like you need food in order to survive as a human being. But lots and lots of it just makes you less healthy. But the venture capital industry has a different view of that. And because what we have to supply is capital, we think it is magical things. And we like to look at companies, we live at 30,000 feet, and we like to look at companies as outcomes and do this crazy thing that VCs call pattern matching, to believe that they can see at the beginning what the outcomes can be. And they skip over, because they don't even understand it in many cases, what actually has to happen to get to that outcome. So my grotesque analogy for it is like we inject steroids into babies, hoping that a few of them become Olympians, and we discard the rest with no regard whatsoever for the implications. I say we, I hope that's not what we do at Founder Collective. I don't think so. But as an industry, we do a lot of that. And I could go into all kinds of detail about the mechanics of how that happens and what does capital really do and why can it be really good but also really bad. But I think at the end of the day, you like to call them real businesses, but 95% of the businesses in our industry that get funded by venture capitalists are not in a position to actually intelligently scale, and yet they go for it anyway.
That's an incredibly concise distillation of what was actually a 56-tweet storm that you published.
I'm known for nothing if not being long-winded, so yes.
Yeah, there were a few things that struck me. One, I think at the heart of both what you just said and your tweet storm is essentially like there are some structural and incentive issues that I think you've done a great job casting a spotlight onto. That a lot of people, it's like the things that go unsaid oftentimes, and the invisible hand that moves a lot of behavior that people, I think, wrestle with, what appear to be really smart people doing really dumb things, like obviously dumb things. I think that was one thing that I took away from it. The other thing that I took away from it was the reaction to it. Because the reaction to it was universally. I mean, I went through all the replies, I went through all the reposts, I went through all the everything. I did not see a single person say, this is dumb. You're wrong.
And how many people hear about indie from our industry and the problems you're trying to solve for and say, forget about whether they like the solution, that the problem isn't real, right? It doesn't matter how much you are one of the primary culprits in promoting the problem. You still would prefer to see everyone else not do the same. And you would know the problem's real. Sometimes you feel like, well, that's not me. But yes, I work at a $5 billion venture fund and I do all these things, but that's not really me. There are things people strongly disagree with me on, but I think people have a hard time arguing, for example, that VCs don't overly pay attention to TVPI, and therefore they have a set of incentives that make them very short-term thinkers. They're very excited about the next markup. They're very excited about the valuation and the amount of money that went into each company, because that is how they promote within their firms. It's how they promote their firms to get more capital. They do want more capital. So there's a lot. I don't want to just put it on the VCs, because it's also the entrepreneurs. It feels better to raise money at a $100 million pre-money than at a $50 million pre-money. It feels better to raise $20 million than $10 million. And you believe in your heart of hearts that I'm in control of the capital. So why wouldn't I rather have control of the capital right? And then I get to make those choices. And that is really logical until you realize that you're being influenced, first of all, by a lot of people who you don't totally agree on what you're trying to accomplish. I mean, I think a lot of this comes down to, and it's true in politics, it's true in international state, and it's true in venture capital and almost everywhere, people don't even agree on what we're trying to accomplish. So I say in our industry, what we should be trying to accomplish is building companies of great intrinsic value, increasing intrinsic value. Everything else is vanity and dilution. And that is not, in my opinion, what I think most venture capitalists truly believe they're trying to accomplish. They might say, yes, in the end game, sure. But along the way, right, like more capital probably means you'll create more value. And I don't actually think that's true at all, right? And that's a good point of disagreement.
The interesting thing is today you don't have to think. The data is actually like the jury's in, right? Like we just went through a period of ridiculously cheap, absolutely abundant capital with effectively the same outcomes.
There's no question that there is tons of data that combats this theory. But the problem is, again, a lot of people live at 30,000 feet. The venture industry absolutely does. So if you're a VC who is, let's say, not intimately knowledgeable about a company, let's use any company. Let's say Uber as an example. You could look at Uber and say, look, the game is highest valuation, most capital, go as fast as you can, first mover advantage, blow out every market as quickly as you can. And what you don't know, if you weren't involved in some way, is like, what were the unit economics in all those early markets that justified that investment? Not to say none of the investment was too much or whatnot, but there was very clear, real justification. The problem is, again, most companies never look that way. There are very few companies where you say, well, geez, like this is scaling unbelievably well on a unit economic basis. It's a machine where I can put $1 in and you give me $2 back. Let's just do that. So this is what I talk about. Capital is a compounder. So you say, well, that's great. I want to compound. Compounding's awesome. And the question is that no VC really ever asks is, are we compounding positive value or are we compounding negative value? Well, I don't know how many people have thought a lot about compounding negative value, but you compound to zero pretty quickly, right, when you compound negative value. And most venture systems, meaning a company that has venture capital, is largely compounding negative value. And our industry almost celebrates, they don't realize they're celebrating this, but when they say growth at all costs, and you think this mantra's over, but it's not, and they pay no attention to what the real economics are of that business, have they created a machine you can invest in and put $1 in and get $2 back? And it doesn't always need to be in actual dollars. It can be other forms of intrinsic value, but those are harder to quantify, and that is tricky. But if you're not getting real generation of intrinsic value in a meaningful way by investing in scale up, you're damaging the value of your business and you're diluting it. It's not financing rounds that really cause the dilution of your business. It's whether or not every dollar you put in is creating more money. And I'm not talking about profitability. I know you talk more about that. Profitability is a tricky one too, because I'm happy, I'm an investor. I'm happy to invest money in things if they have good economic engines of return. I don't need companies to all be profitable. I actually don't think most high growth companies should be profitable if the opportunities are there and you can invest in growth in a really healthy way. But otherwise, you probably want to be profitable for sure. But I think it's less about that question and more about, is the capital going into a positive economic equation? And then sort of point two is, every economic equation that's positive has a diminishing return. By the way, everyone that's negative does too, right? Yep. So you're going to diminish in value of what you're compounding in either direction. So if you have a close to positive formula but slightly negative, it will become more negative over time. If you have a marginally positive formula, it will quickly go negative. And so why? Because we can use the Uber example. All your early markets are showing these amazing appreciations that make you think you should go everywhere. And that was right? But you've gone after the very best markets you can imagine in your first 30 markets. So at the end of the day, each market is probably, on average, a little less attractive than the market before. Otherwise, you would have chosen it before, right? And so it takes a long time for an Uber, because of a lot of dynamics there, to hit a real diminishing return. But for most startups, they marginally get positive. They go put that out to the venture industry. Sometimes they're not even positive at all. They sell a story, they get capital, and they accelerate against a system that doesn't work. and then they just compound negative value. And then one day the 100 employees are all laid off and they're wondering why and how could that be? Yesterday we were doing great. And the number of friends I have who say, oh, it's an amazing company, they've raised $100 million. And I'll say, okay, great. Tell me more. What are the fundamentals? And they're like, well, they grew 40% last year. And you're like, okay, it's a tough market. It's pretty good. They grew 40%. Tell me about what did they invest to grow 40% last year? Do they invest 20% negative EBITDA? Do they invest 50? Do they invest, and they don't even know. So they raised all that money. How much money's left? They don't know, right? And it's like the denial that happens until the company needs more money. And then there's this super difficult conversation around the table where everyone's like, oh yeah, I didn't mention it before, but this whole thing doesn't really make a lot of sense. Well, what just happened? In a moment, it feels like you dropped from valuable to zero, but really it was the negative value the whole time that you were compounding that took you there.
Why I thought it was timely to at least talk this through is because you put it into a fairly, concise, but also complete articulation of some of these ideas that I know have been bouncing around for a while. So what I was curious about is kind of what prompted that. I
mean, we're always trying to figure out better ways to explain what we think is unbelievably complicated. Like very simply said, as capital has no insights, which sounds really cute. And and somebody else said, well, I always say venture capital has no insights. And I'm like, well, I'm being critical of the approach in the industry, but there are plenty of insightful venture capitalists. That's not really what I'm trying to say. I'm just trying to say having capital itself does not solve the problems of your business. You need gas in the tank to drive your car. But if the car is really problematic, it doesn't matter how much, having more gas is not solving that problem.
My partner, Tim, used to say, a road trip is not a tour of gas stations. It's really easy to confuse the idea that the fuel's great, but the fuel is only, if it's only taking you to the next gas station, that's hardly the point. I think from your perspective, you would say, and I would too, that we've turned funding and fundraising into a primary activity that drives a tremendous amount of behavior.
Totally. And VC celebrity is based on that, and VCs have gotten louder and louder because their importance to themselves and to their view of the industry is based on that. And they want to believe, the other thing that they want to believe that I don't believe is that they're fortune tellers of the future. So it's a combination of I'm a fortune teller of the future, and what the pixie dust I have to offer you, the drug I have, is the only, will solve your problems, right? It solves everything. And your company's successful when I validated your company, right? And by the way, VCs are so skeptical of each other that your company is not successful when others validated your, but the reality is venture capital is not a validation. And it's very interesting and hard to believe, but in non-commodity scenarios, very often the less funded competitor wins. And I think that's something that's really hard to appreciate, but the capital drives the players who aggregate a lot of it without really good systems to make really bad choices, damaging their systems over time. They can damage the whole space to a certain degree, but if you have a competitor in there that's sophisticated and it's a non-commoditized situation, they really can crush everyone else, right? And that happens a lot.
Is there a company that you have in mind that comes to mind when you say that?
Well, there's one company that's my poster child for all of this, but I learned a tremendous amount from Jeff Green on the trade desk. It's not the best known company. A lot of people don't know the story, but you're looking at a company that burned, we raised a little more, but we burned $7 million before being a public company. And today it's worth $50 billion. So I don't know how many $50 billion companies have been venture funded in the last 15 years, maybe a dozen. Our competitors all raised hundreds of millions of dollars, right? So you would argue, a lot of people would argue, I think the venture industry would argue, these guys have no chance. But just to dig into a good example of what happened it's in the Adtech industry. The Adtech industry is a very complicated, effectively, value chain where the agencies play a very complicated role. Agencies are not worth a lot of money. These are companies that are valued maybe at 1x sales. So at least the market doesn't view agencies as a really high leverage business, but they're big businesses and they have a lot of influence. So what happened in Adtech is when all these companies raised so much money, because there was a real wave of what was going on in terms of things were moving to digital and programmatic and auctions and algorithms. If you raised all this money, what you're trying to do is grow as fast as you possibly could. And the easiest way to grow was to try to take the value away from the agency and go direct to the customer. You could afford salespeople. You could afford advisors, account reps who would manage these accounts and help the companies work direct on your platform. And so almost everyone in the industry built huge organizations to replace the ad agencies. But the problem was they all became ad agencies, which was a low leverage, not great business. The trade desk, partially because it wasn't easy for us to raise money, we were kind of the last ones to have a scale system that came into something that was exponentially moving, so it was very hard to come in with a new system to compete. And a lot of money had gotten to others, and it was hard to tell the story. It wasn't easy for us to raise money. And Jeff always had this view like, look, I can work with the agencies, and my job is to create technology and work with the agencies and actually build real tech that they can use to succeed. So we focused on serving the agency, not becoming the agency. But when you had a ton of capital, that was the least obvious thing to do, was to let the agency have a huge percent of the margin in the business, right? You wanted that margin. I actually even had a VC who said to me about it, one of their investments in the space, that the problem with the investment is, unlike a normal software company, it only had 40% margin. And I'm sitting there and going, does he mean margin or take rate? I think he means take rate, but people were very confused about this because people are very into vanity metrics. So take rate was always talked about as revenue. And for many years, even the public companies until Trade Desk presented their financials this way, right? And he was complaining that the take rate was only 40%. Well, most people know there aren't marketplace businesses that go to scale with 40% take rates for the intermediaries. That doesn't really exist. And we're sitting there at 20% at the time, and I'm thinking, oh my God, either I totally don't understand the business, like we may just get killed. Like these guys have double our margin, right? Like we're doing something wrong, or maybe like we're actually the only ones really providing just technology. But I didn't really know at the time, right? And it turns out like years later, it's still a 20% take rate because that's the technology take rate. But you can see how the VCs were saying to the entrepreneurs, you got to raise those numbers. You got to figure out how to get those take rates up. Well, okay, maybe if we get rid of the agency, we can do more of that. But I think at the end of the day, they were investing hundreds of millions of dollars into systems that were not good systems. They were negative value systems. And at the end of the day, none of those companies became great companies.
Counter to the kind of conventional thinking in venture would be that the best funded somehow wins, that somehow people are getting kind of crowned victors, king made, by the venture investors they have. In fact, the other day, I tweeted something, there was some article that came out about, how I want to say it was like half of the venture money from LPs going into the asset class was going to like 5 firms. My response to that was terrible for the venture industry, maybe the best thing to happen for entrepreneurs. And the response to that was, wait, that seems opposite. Like, what happens when that big fund crowns the winner of a category and they become the one that is like so well funded you could never compete with them? I think that gets to the heart of what you always say around capital has no insights. I wonder if capital also has no advantage, but I don't know that that's always right, because the two examples, I hear you talk about a lot. You've got this like very heavily weighted experience with Trade Desk, ultra capital efficient, massive outcome, and then Uber, where and when people think about growth at all costs, winner take all types of markets, it's kind of the poster child for those, no?
Yeah, so I think it's fair to say that if you have a system that has a great economic engine, and then there were some other dynamics there that were very powerful, capital can be a great compounder. Like at the end of the day, I don't think the Groupon business was ever a good business. Group buying, and people, if they don't know, there were hundreds of group buying companies, as if like, it's sort of the way we talk about AI today. Like the big innovation of that time was group commerce, right? Which sounds crazy today, but that's how VCs thought about it at the time. But if you looked at a scenario where you said, look, basically these are all commoditized versions of each other, but Groupon actually has a really incredibly positive economic system, then you can just blow away all your competitors by having the most capital. I don't think that's really what happened, and I don't know all the stories well enough. They did last for a while, so I don't want to talk out of school about what happened. But if you look at Uber, they had these very positive unit economics in all these early cities. And there was a first mover advantage. There is a network effect in these cities. So if your wait times are 7 minutes on average and your competitor's wait times are 12 minutes on average, your competitor has no choice but to subsidize like crazy to try to figure out how to compete with that. And so it really matters. It certainly was very hard on Uber when they went into China and they weren't the first mover in all those markets. But there are moments where capital can make an enormous difference. The other thing we should recognize is there's a causality problem here, right? Because ultimately, at large scale, in late dollars, the companies that are the highest performers should be able to attract the most capital. So it's really unclear that it's the capital.
But it's an effect, not a cause.
That's right. And if it's done too early, because I think the problem is we're all incredibly ambitious, right? Founders are ambitious. That's why they want to start these companies. VCs are ambitious. One VC friend of mine at a huge firm said, we just want to blow huge holes in the ground. Like, let's just force these companies to scale as quickly as possible. Most of them won't make it. It's no problem. But some of them are going to become the best companies of our time. I think the problem is that's just such a high level comment, right? Like it's so 10,000, 30,000 feet in the air, and they don't actually understand what you have to build in an engine to invest in order to actually go at that speed and succeed. And that the further you push that engine with capital, the worse and worse it's going to get over time. So it's got to be really good, and very few are very good. But because we're so aspirational, we just skip the experimentational phase. People start to say things like, well, we need it to work, so it's going to work. Nothing works because you need it to work. At the end of the day, you make your plan because you've created a system that actually delivers, right, overall, right? You have a product that customers care enough about, and they're sticky, and they care about it, and the net promoter score is high. And you build a sales organization that learns how to sell it, a marketing organization that gets the leads, a customer success organization that saves the problematic situations and helps the customers get what they need to, and help design systems that scale that so everything isn't some crazy heroic action, right? And a business model that works for that, and pricing that makes it. You have to create a system, right? Not everything needs to be perfect, but it has to work in order to keep pushing capital into it. And because there's always diminishing return, it doesn't get better as you scale it. It gets worse as you scale it. So if you're so ambitious, you skip over all the experimentation of proving this stuff, you're just going to build something that's terrible. And I have to say, like, the very disappointing part is the discovery 15 years later that that's most of these venture-backed companies, right? Like, and people say, well, but that's $1 billion company. Well, I mean, it's a $40 million revenue company that somebody was crazy enough to value at $1 billion that burned $300 million to get to 40 million in sales and still hasn't worked it out. And they're not going to, because they were so vanity invested that, like, fixing that now is like impossible. You have to remember there are no grown-ups. VCs are not your grown-ups, right? They don't know any better than you do, and most of them know less. They don't know what's going on with your customer. They don't really understand the details of your organization. They don't really understand the math of your offering. They invested because they want to believe, but really you got to remember, at the end of the day, they invested in your ability to make it succeed long term. This is like my message to the entrepreneur, right? Is like, you've got to own that, right? And by the way, if your system is working, there's always money out there. Demonstrate a system that's working. Like, Bryce, let's make a deal. I'll give you $1, you give me $2. Let's just do that all day long. Of course, I'll keep supplying dollars for that, right? But like the deal of most venture is like, Bryce, I'll give you $1, you give me 10 cents back. What do you think? Well, maybe that's a good deal for you, but as an investor, that's a terrible idea. And as an entrepreneur, it's a terrible idea. And you're just compounding negative value. Well, let's do that at scale now. Why would you do that at scale? It's not a gambling game. This is not about a casino. VCs loved this term, like bets. I'm making a bet. It's a terrible term. That's not what this should be.
Again, when I went through your replies, there was a lot of high-fiving. There's a lot of like, print it up, tattoo it on my forehead. And yet at the same time, what I'm hearing from you is it's actually almost entirely counter to human nature. Like, there's so much emotion overriding, like as you parsed it, it's fairly unemotional. There's no vibes in here. You know what I mean? Like, it's legitimately like, is something working? If it's working, keep investing in it. If it's not working, don't scale it.
Well, I want to acknowledge there is ambiguity at times. And the problem with the ambiguity is you should probably find ways to get more confident rather than go crazy scaling something that is ambiguous, because more often than not, overwhelmingly, the thing that's ambiguous is probably because it's not really working. You've got to get out of your head this idea that, like, you're beholden to some number next year, and you're never going to get to that number unless you're investing now, even though it doesn't work right now. It doesn't work. It's not going to work. You have an economic, make numbers really simple. You have an economic engine that requires each sales rep to deliver $1 million in sales to hit your number, right? And not just to hit your number, for the math to actually make sense. And you're getting $500,000 in sales from every sales rep. What do? The answer of 95% of venture capitalists is double the sales force. Well, it doesn't, the model doesn't work. You can't just double the sales force and sure, first of all, you'll have an even more diminishing return, which is funny, and you won't even get to the number you intended to get to. But if you needed each rep to get to $1 million in sales for the math to make sense, having twice the reps, yeah, you'll get maybe somewhere near the absolute number you're targeting, but you've just doubled the expense, so it makes even less sense than it did before. But most VCs will go the other way. Right?
Why do you think that is?
Only thing you get for free in strategy is wishful thinking. So the way to be undisciplined about strategy, which is just about everybody on the globe, is just to have a lot of wishful thinking about it, right? And you start saying things like, well, we need to hit our number next year, and if we need to hit it, we're going to have to do this now. And so, because we need to, we will, right? We will do it now, and we will hit our number. And it's like, the system doesn't work. You're not going to hit your number because you need to. You needed to hit it last month too, and you didn't hit it. And look, if you're a 35-year-old up-and-coming partner at a venture firm, and you're making your fourth or third or second investment, you don't have a track record yet, and the easiest way to establish one is to figure out how to have growth at all costs, it's actually kind of logical that you would say, well, geez, don't cut back the sales force and fix it. Then we're going to look like we're not growing. But you can't forever keep perpetuating vanity metrics, right? It just gets worse and worse and worse and worse. And unless at some point you say, okay, we need substance, right? We actually have to have real substance behind the things we're scaling and what we're delivering and the results we're getting. Otherwise, they don't justify investment.
Do you think investors are getting better or worse at sniffing out vanity?
I think most investors don't agree with me on what we're really trying to do. They will agree with me at a high level, but they don't agree with me on what intrinsic value means.
One thing in your post that felt like even you were wrestling with how to articulate intrinsic value.
Well, it's hard to articulate for a few reasons. One is you can have value in your business that isn't purely economic value, right? It has to translate in some way over time to economic value, but I wouldn't have argued that cruise automation not having revenue for all those years meant that they didn't have economic value or they didn't have intrinsic value. They were building intrinsic value, right? So it can be hard at times to actually understand that. Sometimes it takes some period of time of investment to get the proof points you want. So I don't want to be too minimizing of things that are non-directly economic. The notion of intrinsic value is a hard one to explain. And what I mean by it is you've created some kind of engine that you confidently can say, when I put $1 into it, I'm getting more than $1 of value back. And I understand experimentation dollars within reason don't look like that. And some capital for experimentation absolutely makes sense. The problem is you have companies burning $1 million a month and all they're doing is experimenting. And by the way, the more experiments you do, usually the worse you do them.
That was my read from your post. It seemed like you thought experimentation had been bastardized. Like it isn't actually very well understood.
I sit on a lot of boards where VCs want to skip over experiments proving outcomes. They just want to skip it. You get back to this, we need it to work, so therefore let's assume it works. Right? And we have 5 companies at FC that have become worth over $1 billion. You could say the valuations are all wrong, but I think they have real intrinsic value that took 5 years or more to get to $1 million in revenue. Right? And I say that because if you believe it's like huge or bust right out of the gate, we're going to start burning $1 million a month or $3 million a month right out of the gate. How long can you sustain that before people go, well, I don't think it's really going to work? But so it's counterintuitive because you think more capital means more time. And I think the really confusing part is, I think generally more capital means less time. Because you habituate a burn rate because the people around you assume it, that becomes more and more obvious should not be sustained. And then you have a problem. If your experimentation is inexpensive and people think you're smart and you're doing interesting things, even if you don't nail the formula, they'll keep funding that experimentation for quite some time, right? Because your valuation is consistent with where you are as a business, which is you're in experimentation phase and you're a smart entrepreneur and you're doing interesting things. And some of these experiments look quite encouraging.
There's some investor psychology you had to manage in those 5 years, you or your partners, who were going to these board meetings, little to no revenue, maybe little to no what appeared to be like real progress, and yet you continue to support these entrepreneurs.
I think the answer to that question is like when you're burning very small amounts of capital and you're seeing encouraging signs in lots of places, it's very easy to keep, and your valuation is not out of hand, it's very easy to keep getting money to demonstrate more and more interesting signs. A lot of things take a long time to figure out exactly how to tune to success. I'll call out Howie for a moment at Airtable. He used to send updates that would say like, here's some of our progress points, here's what we're excited about, here's what we're looking to see in order to get more aggressive. We have 72 months of capital on the books, right? And like, it takes a discipline, right? To say like, you know, look, we're seeing things we like and we could get more aggressive, we could double our engineering team, we could bring in more product people, we could start marketing more, acquire customers, but like, I don't think we're ready to do that. I don't want to spend that money yet. And I'm just sitting on a whole lot of capital until I'm ready to do that. But I'll tell you, this is the hardest thing to explain to entrepreneurs, but I experience it all the time. Yesterday I had this conversation with an entrepreneur. They come back and say to me, I wish I understood the opportunity cost of spending that dollar inefficiently before, when I now have something that I really believe in that it could be so valuable for, right? And yet I don't have that dollar now, right? And that's the thing is like, you know, if you end up raising a lot of capital, I think it is very hard to do it how we did and hold back. You just get a lot of, one of my favorite things to say is focus on learning, not burning. But the venture capital industry focuses on burning, not learning. And they wouldn't agree with me that that's what they do. But I have so many founders who are keeping a reasonable pace and figuring things out and not getting aggressive. And the other VCs talk to them and they're like, you're not going fast enough. And I'm like, well, what do they mean? Do they mean you're not learning fast enough or you're not burning fast enough? Because like, burning more money is just not going to get you to the insights you want faster. I don't believe that, right? And you say, well, couldn't we multitask, 12 experiments at the same time? Probably not. Doing a lot of experiments poorly does not usually find good outcomes. So there's only so, and then people acknowledge the mythical person month is real, but somehow they don't factor it into their thinking on so much of this stuff, right? Or they'll acknowledge it when they say, well, that's why we put together, 4 teams. But like, are all 4 of those teams really a good idea? And do the senior management who's coming up with what to do, are they paying enough attention to the experiments of all 4 of those teams? And it just gets harder and harder to be disciplined in an environment where most people just don't value that. And yet I don't actually think companies succeed without it at the end of the day. And that doesn't mean there aren't very rare moments like Facebook or Uber where the system works so well that investing in it makes a ton of sense. Facebook's a great example of where it was non-economic for quite a long time, right? But then I start asking questions about like, well, okay, how sticky is it really? How much time do people really spend on the site? Is it really viral? Sure it was. Unbelievable for Facebook. And you step back and you're saying, okay, there's viral things happening. People are on it nonstop. Let's just throw out there what we think it could be monetizable in advertising revenue. Could we imagine $1 a year per customer? Easily. Okay, well, we have, 500 million customers. The number was, at different stages, like, okay, we don't have to monetize this minute. We have a theory of monetization that makes a lot of sense and this amazing thing happening that we really can invest in that really is unbelievable intrinsic value. And sometimes that stuff does go up in smoke. By the way, sometimes really good economic engines go up in smoke because things get hard. I have a lot of SaaS companies right now.
I would imagine you've seen also companies who are like, oh, we hit product market fit, let's go all in. And then to your point, something breaks. Like the returns start to diminish quickly over the long term, whatever it is, and they can be caught with their, unprepared.
You have the guaranteed diminishing returns of every single activity in the organization. So you need to create new S curves, right, in various different ways. So that's new experimentation. That's very important. But other things happen, like the goalposts changed. I was going to say about a lot of our SaaS companies, the level of scrutiny of enterprises' SaaS software in bad economic times went up extraordinarily higher. And so churn rates that, a lot of our companies, the churn rates were going down, 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 were really encouraging. All of a sudden they were at, net negative churn, and that was getting even more and more impressive. And you're like, wow, it's incredible. You could sell to no new customers and grow 30% a year without, just having good customer success and product. And then all of a sudden, all of, that, a lot of that went away. And those same companies, went to, however you want to put it, gross churn going from, 10% to 30%, or net negative churn going to positive churn. And so the goalposts do move, right? And then you've got to work within that condition too. You can't just say, well, okay, we just keep scaling anyway. At the end of the day, every dollar you invest really should have at least contribution margin coming back that you can in some way reinvest in the business. Now, it may not be profitability, and this isn't true at every stage of every business, but at scale up, it needs to be true in a meaningful way in almost every condition.
I think that's where we actually violently agree. I think we use profitability as shorthand, but there's nuance in there. To your point exactly. Like I don't know many companies that can hit that kind of high growth scaling without burning.
Well, and this is an interesting conversation too, because there's the profitability sort of extremists out there who pile onto my post as if I agree with them. And
this is why we bootstrap or something like that. Bootstrapping solves this problem. And I was like,
There's discipline to profitability. There's also a laziness in profitability, right? In the sense that if you're really working on something where you have an incredible engine going, you want to be investing in that engine, right? You don't just want to be investing only off cash flow in that engine. Right? It's an amazing, like Uber, it would have been crazy to say, well, geez, we're just going to wait till we generate cash flow in San Francisco for 3 years that we can afford to go to LA to go do the same thing. I think that would be a little crazy, but your contribution margin should be helping you build a better and better business, as opposed to getting worse and worse and worse.
So would you say contribution margin, if you thought about like a dashboard for a healthy business that you want to aggressively invest into, would contribution margin be at the top? Like, what would that dashboard look like?
There's a bigger discussion of intrinsic value that I think is very important, because you can become myopic when you just get into a single metric. But if I was forced to get into a single metric, I'd really look at contribution margin. The danger of that too is, then you could just have massive engineering teams and massive product teams that really don't show up there. So that's got to be logical as well. So you can't just do that. But at the end of the day, if you're creating an engine that is contributing more and more and more contribution margin, then it does start to pay for all those other things and all those investments. And there's a very, very rare scenario where it makes sense to be consistently having negative contribution margin, or that the marginal dollar at least is getting negative contribution margin that you're investing. That's a very rare case. Some of the weird cases I hear people say that I still don't understand is, we want to buy up share. I've never really understood market share for share's sake. I don't really care if I'm the number one or number two player in a market if I have, in terms of share, if I have the better model. I mean, think how many years it took Apple to become the number one market share player in the phone industry. It just happened. Just now. Didn't matter. They were laughing all the way to the bank. They had the best engine of anybody by far. I'm sure they're happy to also have the share, I'm guessing. One of the funny things is, in manufacturing businesses, there really are some forms of economies of scale. I think in tech businesses, there's largely diseconomies of scale.
Oh, interesting. Say more. What do you mean?
Well, it gets back to this diminishing return curve, right? So you want to keep scaling. So instead of being tight about your ICP, right, your initial customer profile, you expand your ICP to a customer that doesn't value your product as much, is harder to get to, churns more, and your return on that customer is just way less. But you want to scale. So you're like, well, I want to go after that, right? You have all these sales reps who aren't that productive, but they're getting you something, and you want scale. So you're not going to get rid of them, because you're like, to me, it's another diseconomy of scale. The incremental software feature is almost always, on average, let's say, you can have breakthrough features, but on average is a diseconomy of scale, right? Like it's very rare that the incremental feature is more impactful than the earlier features, right, of the software on average, right? Certainly we know about marketing, right? Like let's use any part of marketing, but you're always going after the lowest hanging fruit. So what are you doing? You're investing in scale. You're going after higher and higher hanging fruit, right? Now it doesn't mean you never have a breakthrough, but those are experimentation dollars again, and usually not super expensive, right? And then you have a breakthrough and you can do some interesting things. Those are the new S-curves that you're hoping to find all over your business. It's hard to make the case. Walmart can buy at better and better prices because of their scale. I don't think that's true of most SaaS companies.
Then why are we funding them to the tune of hundreds and even billions of dollars?
Right? Like, can we even agree on what we're here to do? Right? And I think there's some notion that the goal of venture capital is to scale companies as quickly as possible. On a certain level, that actually makes sense. But most of the companies we're trying to scale as quickly as possible are not good engines to scale.
Incentives detract from long-term value creation. Like there's something inherent in the way we've structured venture right now that suggests that the incentives are just fundamentally misaligned with the long term.
And to be fair, we're probably better than hedge funds where like you can make a ton of money because one year was an enormous up year and it doesn't matter what happens to your portfolio long term.
That's true. That's true. Think of how many of our friends have retired after a couple good years of harvesting the last few years.
Yes, you raise more money and get better management fees off false TVPI. I mean, I would say to those who are listening who don't really understand totally how the venture industry works, we all get to grade our own homework.
When you say grading our own homework, I think that's a really important point. And so I just wanted to make sure we're really clear on what you mean by that.
Okay, so in 2021, if I have a SaaS company that I got 100x multiple on revenue, which we all knew was nonsense, right? They had $1 million in revenue and they got $100 million valuation, just as an example. Or they had 10 million in revenue and they were valued at, $1 billion. In theory, if I want to, I can say that that company has just appreciated to that value without any sort of recognition that I don't even think that's real and nobody else should think that's real either, right? And then it gets worse. 2 years later, when all the SaaS multiples have plummeted to like 7x multiples, 6x multiples for the good companies, they're still 10, 12, but for really good companies. But like, I still can claim that that company is still worth that. And then we have these auditors who, these are higher integrity individuals. I don't mean to in any way disparage them, but it's not really their job to insist on the valuation. It's only their job to make sure you have a set of rules that justifies them that you publish to your LPs. LPs also like to brag about their TVPIs, their total value overpaid in, those are unmonetized returns. And it's understandable. It takes a long time to get distributed returns. And frankly, in the best companies, you don't want to rush your distributed returns. The fact that they take a long time, it's fine. I mean, we exited the trade desk over time after the IPO, but we would have been way better off to still be holding it today. So the very best companies, so you have this weird incentive structure where, because you have agents, they're much more managers than investors of their own capital in most cases. And they get graded based on TVPI, which is the current value of their portfolio. And so they want to see that number be as high as possible. And they get to grade their own homework. Like they don't have to mark down a company until it has a new financing, or there are certain other rules that start to, over time that they kind of have to deal with. But it really is rules, a set of rules they get to put out there. And then you have this other problem, which is we are very tough on the way we grade our own homework because we think that's all just very silly and leads to a lot of bad behavior in terms of the way you think as a VC. When you get obsessed with your TVPI, you start trying to pump your companies with capital at the highest possible prices. You create this whole system that's so corrupt and problematic. We have LPs who get upset with us because they'll have 4 other funds in their portfolio that are investors in the same company and are holding it at double, triple, quadruple what we're holding the value of that company at. And we are depressing their TVPI to their investors. Sometimes they're bonused on that annually or whatnot. Also, it creates wild inconsistencies that really make it difficult for them to know where they should be valuing these companies. So they push back on us and they're like, well, why are you doing that? And I guess what I'd say is like, at the end of the day, I don't have an incentive to absolutely minimize the value of every company. So you got to believe if I'm doing it, it's because I really believe that's what it is worth.
But that's because you're a curmudgeon. Because you and me are chicken littles around here.
I think we should call it the VC Curmudgeon Club. VCC.
I'm in. We're making hats.
VC3 squared.
Honestly, it feels like our like are growing. I feel like there's a lot of disillusionment that's sitting in the market right now.
I do think part of the reason I got such a positive reaction is VCs are, I don't want to say changing their tune completely, but if they're already in a company and they know they can't get some kind of crazy markup, they are starting to talk more about discipline because they know it's getting much, much harder to upsell. By the way, I think for founders, another very interesting thing is people always wonder why VCs are lemmings, right? And why do we cycle so much into trends? And there's some interesting things there worth talking about. One is entrepreneurs also cycle into trends because there's this weird, interesting dynamic where they want to go where the money is and VCs want to go where the entrepreneurs are. And so like everyone gets each other hyped up on different themes. And we've done a lot of study of themes. I could talk about what's happened, but it doesn't prove out that the theme of the moment almost ever creates the best company. The other thing gets back to this TVPI issue. The best way for a VC to be a maximizer of their TVPI is to invest in the hot theme of the moment. It is the most likely thing to get marked up. So if I see a really, really cool AI company right now, that is the highest likelihood company for me to get a markup from. So you'll literally hear VCs just say, well, I'm totally focused on the AI theme right now. And it's a little like saying out loud, I'm not saying there isn't a lot of great stuff going on in AI, but it's a little like saying, I am a momentum investor. And that's where the momentum is. I'm just so focused on substance. Like when I'm asking hard questions, it's not because I'm like trying to gotcha or I'm like, I think I understand their future or the future of their space better than they do. It is 100% because I want to see them like light up with how awesome it is to talk about the hard questions in their business. Because they've thought about them so much more than I ever would have. And I would say, unfortunately, disproportionately, most founders think they're in the show person business and they come in doing a lot of hand waving and they want to describe this like vision they have in their heads and how what they're doing is so brilliant. And they don't talk a lot about what they've actually done to validate that and how are they thinking about the really tough parts of that. And they're afraid of the vulnerability. Like one of my favorite questions to ask is, you've been at this for 9 months or whatever it is. What have you learned so far that really surprised you and made you change your approach? If you don't have any answer to that question, you're not learning. You can't have like perfectly in your head constructed the future that's going to end up being wildly successful. But for so many founders, that requires a vulnerability that they think they're not supposed to have in that meeting, right? Or they just honestly aren't comfortable thinking about it or talking about it, or what they want to talk about is how brilliant their idea is. And I always tell people, I don't think VCs are in the idea business. I think we're in the people investing business, right? We're really a talent business in many ways, and we're trying to find very special people. And the question is, well, how do you early identify those very special people, right? And I think the only way you can do that is they're the people who love to talk about the hard parts, not any form of smoke and mirrors. Like there's nothing that turns me off more than, smoke and mirrors. I love when a founder says something like, well, look, we don't know yet. And that's a real concern for us, but here's some of the ways we're tackling that. That's so much better than like, well, you don't understand. That's not really the problem. That's not a big problem.
I was going to say, what are the red flags and green flags? So the green flag is some humility, some real depth. Anything else on the green flag side?
I'm looking for the difference between sincere confidence and hubris. That's what I'm looking for at the end of the day. So sincere confidence, there's a reason for that confidence. It's not just I'm a genius, I'm going to be able to, it's like you've done real work in the real world that's helping you understand where you want to go and why, and you've built real conviction about that. Fake conviction's super easy to have.
How do you suss out fake versus real?
It's a real dialogue. Don't you feel like when you interview people, that's a lot of what you're trying to figure out too? They may have an amazing resume, they've been at all these incredible places, and what you're partially trying to figure out is like, do I really learn something from this person? And how deep are they really on this? And how unique is their thinking? And how did they come to that conclusion? And what have they been learning through all the way? I love, like if I ask let's say a consumer performance oriented CMO at a company, we're interviewing for a company. One of the questions I like to ask is like, well, what do you think most CMOs get wrong, about how to approach the market? that makes it so that like the average tenure of a CMO is not particularly long at companies. Like, what do they get wrong? And it's an interesting conversation, where some of them find a way to basically say, well, they're all morons and I'm a genius. But the really interesting ones, I think, are really actually able to articulate a different point of view that's really steeped in some good examples that make you go, okay, like, wow, there's a lot of substance here.
I mean, you had mentioned Jeff, you mentioned Howie. Was there anything in their personality that you picked up on early, or was this like a learned behavior over time? Because you and I both know there's a lot of founders who say, well, look, I can raise 50 million and I won't spend like I have it. I'll forget that I have. I'll be the disciplined one. Was there anything in those two that suggested there was that level of discipline early on?
It's a tricky one, right? Because we're very often going to a company and they have $3 million at the beginning, right? And so they don't have a lot of capital. And most of those founders at that time don't do stupid things with the money, right? And by the way, I want to be really careful because I think if you're not close to what happens in the venture industry, you think people are like having lavish parties or something. It doesn't look like that at all. It's really hard decisions around when do I scale up my sales force? How fast should we scale the marketing? We have all this long list of product features we want to build that we think are right, but I need product management capability and engineers to build it right. When do I make those investments? And these are all extremely constrained systems, right, or resource situations. And even when you raise a lot of money, it always still feels constrained, right? Because it only makes the ambition and the hurdle higher. So you still feel you always feel constrained. And that these are much more decisions about how quickly do I accelerate against my proof points and my ambition, which I think are the two things that are a little bit out of sync in a lot of cases. Raise money because of what you've proven. Don't raise money just to prove things. You can raise small amounts of money to prove things, but the reason to increase the spend is you've proven stuff that makes that clear, or your conviction is really strong because you have real data.
In your post, you basically said funding should only be used for two things:
experimentation and scale. But that's Eric Ries, like verbatim, right? Like, I want to make sure.
Yeah, funny enough, he sent out a note this morning to his mailing list linking like 3 different ways to your post.
Oh, that's very nice. Eric and I have, seen the world very similarly. I think there's a funny notion where people think Eric's point of view or my point of view or your point of view is some kind of conservative notion of how to invest, and it's not.
That's right.
I'm like, go bananas. Invest $1 billion a year if you've built a system that is strong enough to invest $1 billion a year. No problem. I think that's great. That would be the ultimate. Please let me into your startup because you've built something that actually can utilize $1 billion a year successfully. So I'm not in any way talking about being conservative or everybody should bootstrap. Power to the bootstrappers, but many of them are missing a lot of opportunity by bootstrapping, right? Yep. I'm just saying that when you build something inauthentic, driven by vanity to satisfy venture capital, which is largely what the machine of venture capital encourages you to do, and you kind of deep down know it, but you keep doing it, and people are slapping you on the back because the growth rate looks good, even though the unit economics stink, you can't do that forever. And you're probably not going to turn that around, right? Because once you go down that road, it's a very hard road to get off of. And so you have to be smarter than that with the capital. And ultimately, the only grown-up is the founder. Like, the whoever's running the business is really the only grown-up.
I feel like that was a big undertone in what you wrote. Like, your distillation of it was very solid and concise, but it wasn't like rocket science. It wasn't like, it wasn't to the point of like, a big part of it, it felt to me like all of this is pretty obvious. Why aren't we doing this? And again, I think that led to part of the reaction. Again, there's like nuance and layers to it, but part of the reaction was like, yes, of course, Eric's right on, print it up, do the thing. And yet human nature starts to get in the way, or incentives get in the way, or social dynamics get in the way.
I want to fly too, right? But like, I can't just decide I'm ambitious enough to fly and therefore like, I'm going to defy gravity. Gravity doesn't exist anymore. You've got to invest in building a plane that can fly. And then, by the way, you only get to fly it as far as that plane is well-tuned and capable of flying, right? And so you don't get to say, well, we don't care. We need to go around the globe 3 times. And so it doesn't matter that this plane can't go around the globe 3 times. We're just going to do it anyway. It doesn't work that way, right? It has to be engineered to do that. And we have to engineer systems that justify investment. And unfortunately, the capital markets encourage people to do otherwise in many cases.
So interestingly, you say the CEO is the only real adult in the room for a lot of these decisions, and yet a lot of them are making very childlike decisions. I mean, in that video Will and I did a couple weeks ago, one of his points and aspirations was that CEOs take investing in their business as serious as they do anything else. That there's a real rigor to the way they allocate resources. And as you know, in startups, that is not the case generally at all. How much culpability is now on the entrepreneur versus just the investors?
The culpability is everywhere, right? I mean, I don't want to just say, I was a .com, era tech person. And I was 20-something. And everyone blamed the 20-something kids. But you had all the VCs slapping on the back, telling them what to do. And then, when everything went wrong, it was like, well, it's just these kids were such idiots, right? And yeah, maybe we should have invested in these kids. It's an ecosystem, and we're all in this together. And what we need to actually start to agree on is we have a long-term view of what we want to build. I mean, there's this crazy thing that happens. You look at the whole SPAC economy, right? Yeah. Ponzi scheme, effectively, right? You basically created a system where you had all these companies that really were not fit to be public companies. And nobody thought really seriously about what happened the day after they became public. And you had all these sponsors who were running off with making money just by getting them out there. Most of these companies were terrible companies. And if you look at the SPAC index, it's I don't know, it's down 97%. And,
something like that.
And I'm not saying there was never a situation of a company ever that should have SPAC'd, but mostly it was a way to go public when you were not substantially ready to go public. I think when people start putting near-term economics, we're going to get rich, near-term economics ahead of we have a job to do, which is satisfying a customer well and creating a system that allows us to scale our ability to satisfy customers well, meaning you learn how to market to them, to sell to them, to support them, and you build better and better product for them. You lose track of that, and you're just like, we're going to get rich, and the rest of it we're not worried about. You got a big problem. How the lessons are just not, they don't sink in, and the incentive structure of the industry is still pushes this I'm happy to see Blitzscaling, to use Reed's term. It'd be interesting to debate him on it. I have great respect for him, truly. But I think the idea that every company should blitzscale without regard to whether or not they've built something that should blitzscale doesn't make sense, right? And the reality is there are very, very few companies that get themselves in a position to blitzscale, and so many try before they've ever figured out a system that would allow them to do so. So they're euthanized. You don't even find, they never find out if they could have built something that might have blitzscaled because they went to blitzscale mode before they had anything that you could credibly blitzscale.
It's so right on. I mean, obviously, they're that famous, was it Gordon Moore quote or the more companies die of indigestion than starvation. The reality is you've got this foie gras effect that we've lived through, and a lot of these companies will never know really what they could have been. I think the question for me now is have we learned any lessons? Because I woke up this morning to Dan Primack's newsletter, and there were 5 9-figure rounds at the top.
Yep. I mean, it's also very interesting. I think there's this weird thing that happens in a world of scarcity. People are so desperate for any oxygen or any nourishment, and frankly, any validation. It's very hard to be a founder, even in this environment with tons of capital, because you're constantly afraid you're going to fail, and you're looking for validation. But then it flips over, right? Once you start getting interest and attention, all of a sudden in this setup, there is a lot of plenty. Now, admittedly, that's very unequally divided, around gender, around race, around education types, around market sectors. Totally around market. I mean, I built a digital 3D imaging company in dentistry. It's hard to raise money for that kind of company, right? The problem is all of a sudden when you go from that scarcity to the plenty, it's you really view it as validation, and it isn't in any way validation, right? But it's so hard to say no to, because all of a sudden you're like, and people are going, this looks awesome, go faster, get more aggressive. And you're like, well, they've seen a lot of this before and it makes sense. And people are telling me I'm a genius. And like, finally, I was an idiot forever. Now I'm brilliant. Like, go, 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 go. And you build WeWork. And the whole time your valuation's going up, you're actually compounding value to zero.
That is such a perfect example of negative compounding.
And the funny thing is, what's actually happening doesn't look like what's happening in the capital markets. But there's a reason why WeWork was worth $40 billion, and then a few months later was barely worth $2 billion, and then ultimately ends up in bankruptcy, is negative value compounding.
Any response, reaction, feedback you've gotten to the post that surprised you?
I always think a lot about the edge cases. So we've talked a lot about this today. Like, how do I think about somebody who's building harder tech? So, you think about the LLMs, right? And there may not be a clear monetization, but if you have some really sophisticated theory, let's say, of a better AI system, but it requires building this huge thing, now what, right? And I want to leave room for that. Like, we have a very, very strong deep tech sector here in Boston, but there's a lot of danger also in things that are not well validated in the real world, having tons and tons of capital, because again, you can really corrupt what you have very, very easily and build stuff that ultimately doesn't matter very much. I'm used to a lot of software companies where you can validate things at very, very small scale. I talk about experimentations being inexpensive, but there are certainly scenarios where experimentation is not inexpensive, right?
No, that's right.
And I guess in those cases, what I'd say is you need to find other ways to validate those markets, very deeply validate those markets, because it is possible to spend a fortune building something nobody wants. When I hear somebody's raised $100 million out of the gate, my immediate reaction is, wow, that is exceptionally unlikely to work.
Why?
Well, it's exceptionally unlikely to work because you're now going to accelerate your burn rate and your scaling against things that don't work. But because you need to make it look like it's working, you're going to start leaning more and more and more into vanity, and you're going to put so much energy into driving those vanity elements without real, actual system validation in the real world that this makes any sense. And the idea that, like, I always think, like, almost nobody's ever birthed a platform. You earn the right to create a platform by usually starting with a use case. And then, when you're dominant, you've dominated that use case, you can broaden and offer more. But almost nobody births a platform, but VCs see platforms as the end game, and so they want you to birth a platform, right? And they don't understand how you get there, they just understand the end game.
Well, it feels like the entrepreneurs, I don't know if you've seen this in your experience, but I've heard plenty of them justify lack of performance, poor allocation of resources, because they effectively wave their hands and say, well, we're doing something really hard. This is incredibly hard to do. Don't, and I think, the indie part of me is always saying, well, is it that hard? Like, are there easier, shorter term things we can validate here? Or do you just feel a lot better telling people? Because I think, to your earlier point, when you start talking the way we tend to talk about startups, people tend to think you're being conservative, that it's somehow like a smaller swing, or that your expectations or ambition is a lot lower. When in the reality, you're like, how do you shrink this to the smallest piece that we can validate and move forward with?
Right, and build learnings that you can keep investing in and learn and learn and learn. And what I will say is, launching at scale or trying to scale something that doesn't work, it is really hard. They're right. It's nearly impossible. Like, you don't have the learnings, you don't really know what you're doing, you've got a million leaky buckets all over the place, and you're like, well, the reason we have it in our numbers is this stuff's really hard. No kidding, It's really hard. Like, if I gave you $1 billion tomorrow and said, okay, go compete with Uber, you didn't learn any of the stuff they know. Now, you can study them and learn some of it, but you don't know any of the inside stuff that they know. If you start with, like, building blocks of things, and you can accelerate based on stuff really working and the learnings you have, ultimately the goal is to create, the race car that really can go way faster because it's so well built, and you can pass everybody because of how good what you built is. Not the race car that's literally coming off, every part is flying off of it the entire time, and like you need pit stops every 10 minutes because like you're trying to run it at a speed it has no idea how to go at. The idea that with like very limited learning at this point, we can all of a sudden just go to amazing scale on something, and people just talk about that as like being bold. I don't know that that's bold. You know, it's like I have an idea and we're gonna put a ton of money behind it and just make it happen. I don't think that's bold. I think it's foolish.
When has it worked? Like, can you think of many?
Look, there are certainly companies that have established systems that you can invest very aggressively in. Absolutely, right? And the other thing that happens when these companies fail is people start saying things like, oh yeah, well the idea was never good. Any idiot knew that was really dumb. Because again, we're so fixated on ideas, right? Like it's all just about this idea.
Well, that was a line I came back to a few times in your post, which was like, the kind of cop-out answer is always no one wanted the product.
Totally. And like part of the reason why people think they can scale things they haven't validated is because the idea is brilliant. As if like successfully building a company is one single idea, right? But the idea was so brilliant we could just take it to scale. So if, Bryce, if you're brilliant and we believe in you and you come to me and you pitch me something, you've done no validation on it whatsoever, I can just give you infinite money because like it's brilliant, right? And like we just invest in the idea and we're done. Right? But that's not really what happens. It's kind of what it looks like for people who have never been entrepreneurs. It isn't about the idea. It's a huge formula. The formula takes tons of tweaking to get right and put in a position where you can drive it. And then there's also this question like, such and such was an amazing company. Why did their growth slow down? Why can't they just grow forever? And I have to say, in my early days of venture, it was one of the most baffling things to me was like companies I thought were amazing and why their growth ever slowed. And then I just started believing that it just gets harder the bigger you are to grow. Growing off $1 billion revenue base is just harder than growing off a $100 million base.
Large numbers.
But here's the problem, right? You're supposed to have economies of scale. So it shouldn't be that way. It should be the opposite. But that's the diseconomy right there, right? And that's the issue, right? This diminishing return curve, you deal with it at every part of a startup.
I guess the lingering question I've got then is like, why should entrepreneurs care? They're just playing the game, man. Just let them play the game. Why should they care about this stuff? Because you and I both care a lot about it.
I think your critique of me and my critique of you, right, is we agree on the problem. We have different solutions. My solution largely exists within the game, and your solution largely exists independent of the game, in my opinion, largely. And I guess what I would say is much like my point of view on this and the way we try to attack this as Founder Collective, which is you can't just ignore the game. The game exists. It's real. So you're going to have to play the game to some degree. It doesn't help to resent the game. Maybe you and I do anyway, but it doesn't help to resent the game as a founder.
No, look, that's my evolution on the indie front, right? Is I think that first iteration was very much trying to build outside the game and coming back, again, back to that idea of experimentation and iteration. Part of that experiment was to say, is there an alternative universe here? I think part of it is coming back and recognizing like it is what it is. And it's, there's good and there's bad. There's trade-offs. We tried to play with structures. We tried to play with incentives. We tried to play with all that stuff. And ultimately, I think where I got lost was it was all in the service of building more scaled, breakout, valuable, durable businesses. And like actually all that other stuff doesn't matter. You know what I mean?
I think you said that beautifully, because I think if you can educate entrepreneurs that the goal is to build long-term intrinsic value and durable businesses, and to not they got to play the game to some degree, but to not, because it helps to have capital at the start of a company, right? It's not, having $10,000 to try to build a tech business, it generally doesn't work, right? Like you need to be able to experiment, or at least with 10 grand, maybe you get to run one tiny little experiment and you're done. Right? And you get no team members and you get no complementary skill sets, and it's really, really hard. You need a diversity of skill set, otherwise you can't win, right? Generally speaking. So capital can be really, really valuable and really helpful, but it's trying to help teach entrepreneurs that they have to make the trade-offs, and that the game exists, but they don't actually they have to play it to some degree, but they don't have to get so caught up in it that they lose what they're really trying to accomplish, which is long-term durable value. And if everything they're doing is with the compass of creating long-term intrinsic value in my business. I remember having this great conversation with Jeff Green. I said, Jeff, it occurs to me that most entrepreneurs are very excited to get public and hate being a public CEO. They don't want to be a public CEO, and it's kind of devastating. And I had some experiences with other friends who had taken their companies public and just found it crushing, not just reporting to the street, but also seeing their stock go down and all this stuff. Are you sure you want to go public? And he said, look, I see such a long road ahead for this business in terms of where it's going. And by the way, we've been so underappreciated in the private markets. And I'm seeing other companies in our space go public and make the market distrust the space more and more and more. He's like, I just feel like I've got to get public and show people the value we can create long term. That is such a long-term view, right? And by the way, very rarely do founders really get a lot of liquidity, right, when they go public, right? They get to sell little bits over time, and if they sell too much, everyone's like, and you're running the company, everyone's like, well, this guy doesn't believe in the business, right? So you have to have a very long view. The VCs can sell it all in 6 months, but they're locked up, right? Maybe some of the employees, but anyone who's on the management team, certainly the CEO, you need to have a very long view. I think if you can get the founders to understand that the game, it is actually not, I just went through the college process with my daughter, it's not completely unlike that in the sense that it's pretty hard to ignore the game, but you got to be careful not to get so caught up in the game that you forget what matters, which is like finding some place to go to school where you feel like you'll thrive and learn and enjoy. But you've got to keep it in perspective. And I think the problem is VCs don't help entrepreneurs generally keep it in perspective. They're in the deploying capital business, and that causes them to think in a way that encourages entrepreneurs to lose track of what matters. And VCs very often sell all their stake the second they can. So they're not a long-term thinker, and in many cases, I don't want to say everybody, but it is all about building long-term and durable value. Long-term intrinsic value and durable businesses is the term you used, and I love that term. And if you can just keep the founder focused on that, they'd start to understand why, going from burning 10 million to 30 million this year when the business doesn't justify that is just dumb. It doesn't matter if Insight just came in with all this money. It doesn't matter, right? Like, either don't take the money, or if you take the money, put it in the bank and say, yeah, we got a few things we need to solve before we ramp up like that. And before we start burning $3 million a month, I got to test what it looks like to burn $1.5 million a month and see if I can still keep the machine running the way I want it to. And if not, we'll fix it, we'll tune it, and then we'll start accelerating again.
Well, I think that's right. I mean, I always think, the way we talk about it now is not playing a different game. It's just playing the game on your own terms, right? If you can insulate yourself from these kind of wild swings in the market and your category falling in and out of favor and offers coming and blowing up, and the more you can insulate yourself from that, the more independent you can operate, the better a business long-term you can build. That's the idea.
And you're on your own track. When you have some friend who says, we grew 300% this year and you only grew 50, but your friend burned crazy amounts of money to grow 300% this year, and you were break even growing 50, it is not clear who's done better that year. Probably you did.
I think that's the interesting thing about some of these bigger compounding breakout companies is, I remember talking to Tom from GitHub. We did an interview, and he was like, it was never exponential. Like, it was always just like 20, 30, 50. Like, it was never 3x, 5x in a year. It was always just like, but, over a long enough time frame, that becomes a pretty valuable business.
I mean, even if you take a $10 million business and you start compounding it at 30% per year over many years, it's an enormous, and I think that's the thing that people tend to lose track of, and it causes them to start compounding negative value because they look at that $10 million business and they're like, I need to grow it 100% year over year. And it's like, well, maybe if you can, and that makes sense, but a lot of the ways people go about that, we've talked about a lot, doesn't make sense. And you're on your own journey. You really have to focus on building great value.
There it is. I see we're at time. This now ends the first convening of the Venture Capital Curmudgeon Club.
The VC cubed.
Oh, that was really fun. I mean, I can't believe we've been going for like 2 hours.